Hey everybody, Steve here with IBC Global. Today we are going to discuss the cash value in whole life insurance policies, how the cash value works, and how to maximize it. Let's have some fun. So with whole life insurance, specifically with individuals who are focused on the cash value, one of two things usually occur. One, they are presented a whole life insurance policy, or they even purchase a policy and their objective is cash value. They often state, I don't care about the death benefit. They get that policy and then they go discuss it with friends and family, a financial advisor, another insurance agent, and they found out that they've been ripped off. And then you hear whole life insurance is a scam. I bought it for the cash value. I was sold based on misinformation. You may have felt like that before. But then on the other side, you see big banks, corporations, wealthy individuals position boatloads of cash here, and they say, it's the best, Jerry, the best. Depending on when you were born, you may or may not know what show that's from. So when it comes to the cash value of a whole life insurance policy, the people that we work with at our company, so individuals and corporations, small and large, when they are purchasing whole life insurance, really how they're purchasing it is not how much death benefit can I buy and how much does it cost. They're not interested in that approach. It's more so, I like the cash value. Here's how much money I would like to pay in, and how do I minimize my death benefit and maximize the cash value. Why they are interested in the cash value is typically for these three reasons. It is a safe, liquid, tax-free area to position money. Now, to provide some additional information on these points, when I say safe, if things are going very, very well in the stock market and economy, or if things are going very, very poorly, you can expect a properly designed whole life insurance policy to produce somewhere between 3 to 5% as far as a net growth rate, what the insurance company will refer to as the internal rate of return. Now, if a policy is not set up properly, typically I can see it produce between 1 to 2%, sometimes 3%. When we hear these horrific stories of whole life insurance and how people are just scammed and ripped off, it is typically when one is interested in the cash value, they purchase a policy and it is not set up for high cash value. It's structured in a fashion where it's a very, very high commission, typically to the insurance agent, which means it's more weighted toward the death benefit and the cash value is not attractive. That's where we see low growth rate on whole life insurance policies, specifically around the cash value. So safety, no matter what happens, your money will continue to go up over time. Liquid, we can access the money anytime. A unique feature to the cash value in a life insurance policy is that once you have money in cash value, if I let it sit and grow, let's assuming it's earning 5% for simplicity. If I just let it sit and grow and earn 5%, it'll continue to earn 5%. If I elect to borrow against the policy, let's assume that you have $100,000 in cash value and you borrow $50,000 against that policy, there's $50,000 remaining, but you will continue to earn that 5% net growth rate on the full $100,000 as if you never touched it in the first place, meaning there's no lost opportunity cost and your money continues to compound. So where it's liquid and I can access it anytime, the other feature is that it constantly compounds. A lot of real estate investors and business owners are very attracted to the product for that specific reason. And then tax-free, but we have it in bold caps there, if I do things properly, the policy continues to grow tax-free and I can access it tax-free. So to provide a quick overview here, when it comes to a whole life insurance policy, I can make payments to the policy. What happens, I have a death benefit that will gradually increase over time, and then the cash value piece will go nowhere but up. Again, regardless of what occurs in the stock market and the economy. That cash value just continues to appreciate over time. The question is, how do I make it appreciate at the fastest rate possible and give myself more money to access? So, most important thing here, with a high cash value life insurance policy, what that means is that the policy is designed in a manner with minimum expenses and maximum cash value from day one. And then the second piece is the company selection. There's a lot of insurance companies out there, which you don't need me to tell you that. Among all of the insurance companies out there, when it comes to high cash value products and companies we've seen consistently deliver the strongest cash values to policyholders, both on the corporate level and also individuals, so big banks and corporations and individuals, we've seen the 4 major mutual companies consistently deliver. Those companies being Mass Mutual, Guardian, New York Life, and Northwestern Mutual. Now, when it comes to the cash value of a product, some awareness here, specifically in the taxes I want to touch on. Payments that we make to a policy are made with after-tax dollars. So whenever I make a payment, I cannot deduct it like I could with a 401k or IRA. So any payments I make are with after-tax dollars. Now, did you know that when you pay any amount of money into a life insurance policy, you can actually choose where your money goes? It can go toward the premium piece or toward the PUA piece. This has a direct relationship to this piece right here. If the policy will produce between a 3 to 5% net growth rate or between a 1 to 3% net growth rate. A basic life insurance policy will be a policy where you say, hey, I want to get $1 million policy. It's going to cost me X amount of dollars in premium and typically has 0 in cash value right off the bat. So instead of doing that, really what we want to do is minimize this premium as low as we can possibly go. Call it 10% of our total desired payment, and then plow everything else toward this PUA rider, which stands for Paid Up Additions rider. I'll often refer to this as a cash dump-in. And we've got videos that really go into detail on this point under our policy design videos. If you search that in our YouTube channel, you'll see that. But really, to maximize the cash value, I want to minimize any amount of money that I'm paying toward the premium piece and maximizing the PUA piece. That is what ensures you have the maximum cash value from start to finish, especially when you look at the guarantees. But regardless of where I pay that money, it is always paid with after-tax dollars, so I cannot deduct the payments. The growth is technically tax deferred. So as my value grows over time, I do not pay any type of capital gains tax, any type of income tax, nothing like that. And then third, I can access it completely tax-free, but back to this guy, if I do so properly. That's a big if there. So here's what I want to touch on here. If I'm you, my question would be this. Okay, so when it comes to the cash value, safe, liquid, tax-free area to position money will continue to grow. I like that idea where I can borrow against it and my money continues to compound over time. But this, Steve, like you're leaving me hanging here. How does that work specifically? What do you mean tax-free if I do things properly? So when it comes to the taxation on a life insurance policy, there are a couple of things that can occur which would result in me having to pay typically ordinary income tax on the cash value. The first thing is if my life insurance policy becomes classified as an MEC, which stands for Modified Endowment Contract. If this happens, my cash value continues to grow tax deferred, but anything I access, if my policy is classified as a MEC, any cash value I access, with respect to the gains only, I have to pay ordinary income tax. And on top of that, I have to pay a 10% penalty tax if I'm under the age of 59 and a half. A way to sum it up is I do not want my life insurance policy to become classified as a modified endowment contract. So the fun part is we can easily prevent that as every policy has a MEC limit. And we can actually set that MEC limit wherever we want on a life insurance policy. And we reference that in our policy design videos as well. So if a policy becomes classified as a MEC, the gains will be taxable when I access the cash value. If I don't MEC out, I don't have to worry about that. If a policy lapses, the gains can be taxable. Now, there's a bit more to that as well. If I'm taking excessive loans and a policy lapses, I can be liable for any of the gains where I have to pay ordinary income tax and any loan interest that has accumulated over time. We've got other videos on that as well, but it is definitely important to be aware of what could happen if I have a large loan balance on a life insurance policy and it lapses. Back in the 80s and early 90s, when universal life insurance policies were very, very popular, a lot of people purchased them and got into trouble later where they had these large loan balances. Then the policies lapsed. They got these big tax bills, caused a lot of lawsuits, a lot of issues. We don't want that. Another way we could run into taxes is if I cash the policy out, if I surrender it. So, for example, if I have a policy where I have paid in, call it $100,000, just to make the math simple. So I've paid 100 grand. And I have a cash value of $300,000. That is what, with respect to a gain? $200,000 gain. That means I've seen growth of 200K. So in this particular example, if I elected just to cash out the policy, which would be termed as a surrender by the insurance company, what would happen is the gains, the year I cashed the policy out, would be taxable as ordinary income. So it is very important to have awareness on this, or working with an agent who's always keeping you up to date on this kind of stuff. So those are a couple examples of what could trigger a taxable event with the cash value in a life insurance policy. Then we've got the tax-free piece. So tax-free, if we do so properly. Again, this is the point of attraction to so many people. When you look at corporations that just stuff boatloads of money into the cash value of their life insurance policies, they're typically doing it in order to draw out an income tax-free or draw money out income tax-free down the road, typically for their executives and employees. So how it can be accessed tax-free is one, pre-retirement during our working years is through loans. So unless we trigger a modified endowment contract, which is easy to prevent, we never want that, almost never want that. But if we don't have that, I can take out loans up to my cost basis and also beyond my cost basis. So any of the gains I can take out via a loan, and it's income tax free. That's a huge, huge point of attraction to cash value life insurance. So I can take out loans anytime. Now, that's during my working years. Remember that unique feature where I can access the money anytime and it continues to compound for me? A lot of people we work with do that really to invest heavily into real estate. That's where I see it the most, and business owners with their business. But loans are taken out tax-free. And then down here in retirement. So there are two transactions in which I can actually pull money from a life insurance policy. One, I can take a withdrawal, which is exactly what it sounds like. If you're going to take a withdrawal from your bank account, you're pulling money out. It can no longer earn interest because it's gone. Or I can borrow against it. I can take a loan against the policy. When it comes to retirement, typically the most effective strategy to get the most income out without ever having to deal with taxes is to first withdraw up to your cost basis. So if we go back to that example where I paid in 100K, and I have a value of 300K, that $200,000 gain over any period of time, what this would look like is first I would withdraw the 100K, my cost basis. If I withdraw more money than what I paid in, meaning if I withdraw 100,000 and then another 10,000, everything above the 100 will be taxable as ordinary income. So I don't want that, kind of ruins the whole purpose. First, I want to withdraw up to my cost basis and then begin to loan out the rest. Of course, making sure that we never run into a lapse situation, which could trigger a taxable event. So we monitor it, or if you have an agent or advisor that can monitor it for you as well. But those are just some bullet points and an overview to how the cash value works in a life insurance policy. I hope this helps. Please feel free to reach out if you have any questions, and we'll talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.